Today we'll continue with the types of accounting principles. The third type of accounting principle is the revenue recognition principle. This concept or this principle tells us about the receipt of income. When we produce some goods, we render some expenses, or we purchase some goods, we have to pay some expenses. But when we resell these goods or sell these goods, the return we get is known as the revenue, receipts. So this concept focuses on the receipts of income. The realization of expenses is the realization of revenue is the lifeblood of any business, or the existence of any business depends upon the realization of revenue. Maximum realization of revenue, maximum realization of revenue is the object of any business. No business can develop, no business can develop without realization of revenue. The revenue is collected when the goods are sold, or in case of services, when the service is performed. If the goods are not sold for cash, sometimes transaction is on credit basis. So when the goods are not sold for cash, then it is known as credit sales. So cash is not received, but a legal obligation is taken by a legal obligation is assumed by the purchaser or the customer to pay the amount in future. In this way, the income and expenditure of the business is recorded in the accounting year in which it is incurred. So, revenue recognition concept focuses on the realization of revenue. We sell goods or our services on cash or on the basis of credit. We have to focus on the realization of revenue, because revenue is required by any business for its expansion, for its future progress, for further production, and for earning profit. Fourth principle, and a very important principle, is principle of full disclosure. Principle of full disclosure. The disclosure principle of accounting means that the accounts should be prepared so honestly that all the important information related to the business is disclosed properly. This principle requires that all the material, and material means all the money related matters, and relevant facts concerning the financial performance of the business should be fully and completely disclosed in the financial statements of the enterprise. Why it is necessary to disclose each and every fact in the financial statements? Because this will enable the investors, the lenders, the customers, the suppliers to make a correct estimate or a correct assessment about the profitability and financial soundness of the enterprise. the investors who invest money in the business, the lenders who provide us with capital, the customers, the supplier who supply us goods and they deal with us on credit basis. They should have a clear cut information about the financial position and profitability and performance of the enterprise, so that they will rest assure that the business they are dealing with is a very sound and financially profitable enterprise. The fourth type of accounting principle is the matching principle or the matching concept. This concept implies that the revenue income of the current year should be matched with the expenses of the current year in order to ascertain the profit and loss. So according to this concept, all the incomes and expenses of the current year should be taken into consideration to find out the actual profit or loss of the current financial year. If the revenue exceeds the expenses, the difference will be the net profit, and if the expenses after matching, if the expenses exceeds the revenue, then it will result in net loss.